Recently, I saw a post on Twitter claiming that banks create money out of thin air and that this is why money keeps losing value. My first reaction was simple. That's nonsense. Banks work on fractional reserve banking. I remember this from an old introductory banking textbook I read years ago, just out of curiosity, so I was ready to correct the guy. But before replying, I decided to double-check my understanding using modern sources. And that's when I realized something uncomfortable. He was mostly right, and I was mostly wrong. So let's calmly explain what's really going on, without conspiracy theories, without panic, and in plain language. How we were taught banking works. Most people, including me, learned the same simple story. People deposit money in a bank. The bank keeps, say, 10% as a reserve. The remaining 90% is loaned out. That loan becomes someone else's deposit. The process repeats. This is called fractional reserve banking. In this story, banks are middlemen. They lend out other people's money. And for a long time, this description was close enough to reality. But this is not how modern banking actually works. Here's the key thing most people don't know. When a modern bank gives you a loan, it does not first check whether someone else deposited that money. Instead, the bank does something much simpler and much stranger. It creates new money at the moment the loan is issued. Let's look at what actually happens. What happens when you take a loan today? Suppose you take a loan for $1,000. The bank does two accounting entries at the same time. On one side of the balance sheet, the bank owes you $1,000, this is your deposit. On the other side, you owe the bank $1,000, this is the loan. From the bank's perspective, these cancel out. But from your perspective, something very real just appeared. You now have $1,000 you can spend. That money did not come from another depositor. It was created at the moment of lending. This is not a secret. The IMF and many central banks openly state this today. This system is often called endogenous money creation. So are banks just printing unlimited money? No, and this is where many online discussions go wrong. Banks cannot create infinite money. They are constrained by several hard limits. Limit number 1, capital requirements. Banks must have their own money, called capital. If a bank has $10 million in capital, regulators may allow it to have, for example, $100 million in loans. If loans go bad, losses come out of that capital. If capital is gone, the bank is dead. Limit number 2, risk rules. Not all loans are treated equally. A mortgage is considered safer than a credit card loan. A loan to a government is safer than a loan to a startup. Riskier loans require more capital backing. Limit number 3, liquidity and payments. Even if a bank creates deposits, it still needs central bank reserves to settle payments between banks. If customers move money to other banks, reserves are required. Central banks usually provide reserves when needed, but not for free and not without conditions. Limit number 4, regulators can shut everything down. If regulators think a bank is taking too much risk, they can block lending, force capital increases, shut the bank down entirely. So no, banks are not magical money machines with no limits. But yes, they create money when they lend. A helpful comparison is margin trading. A trader deposits $100. The broker allows them to control $1,000 worth of assets. The $100 is the safety cushion. If losses exceed it, the position is liquidated. Banks work similarly. Capital equals margin. Loans equals leveraged position. Losses eat capital. The key difference. Banks don't borrow that extra money first, they create it. So, who actually controls the system? Here's where things get uncomfortable. There is no single mathematical model that fully describes this system. Not for regulators. Not for banks. Not for central banks. Instead, the system is held together by historical experience, stress tests, simplified risk models, human judgment. This works until it doesn't. The system is extremely complex and interconnected. Small problems can stay hidden for years. Then suddenly everything breaks at once. This is why financial crises feel like surprises, even to experts. Think of it like weather prediction, but harder. Too many variables. Feedback loops everywhere. Human behavior involved. When a true black swan event happens, no one knows in advance how the system will react. There is also a subtle but important consequence. Since banks do not need deposits to create loans, deposits become less valuable to them. This may explain something many people feel. Worse customer service, higher fees, less personal relationships, more automation, more indifference. Depositors are no longer the core resource. Capital and regulation are. So is the system good or bad? That depends. It has some pros. Enables fast economic growth. Allows credit for homes, businesses, education. Flexible and responsive. But it also has some cons. Extremely hard to control. Prone to bubbles and crashes. Relies heavily on trust and confidence. Few people truly understand it. This is not a conspiracy. It's a system that evolved faster than our ability to fully model it. Banks don't lend your deposits. They create money when they lend. They are not evil magicians, but they are powerful institutions operating in a system that is too complex for anyone to fully understand. And when something breaks, we usually figure out what happened after the fact. That's not comforting. But it's reality.